First, thank you everyone who's attending this live, and thank you to everyone who's going to watch this on the back end. We truly appreciate you investing some of your time to hear from, one of the voices in the room, as I like to say, when I look to understand what's going on with the economy, the market, and get an understanding. I have a handful of select individuals that over the years I've chosen to build great and strategic relationships with. SIA is one of those organizations, and Phil Argue is certainly an individual that, especially this year, I've had the pleasure of sending some emails in, and he's always gracious to respond to those questions and allow us to have a deeper understanding of what SIA is thinking, what Phil and his committee, he's the head of the Dimes Committee at SIA, is thinking, and the benefit to that and to all of us is a more rounded and less headline-oriented perspective on the market. So Phil Argue is the Director of Investment Strategies within the Department of Investment Management and Economic Strategy at SEIA. And in employing a quantitative approach, he analyzes economic and market history to help shape the firm's macroeconomic viewpoints and contribute to portfolio construction and security selection process. So what does that all mean? That means he's probably one of the smartest guys in the room, I would argue. And so Phil's here to share with us really what SEI is thinking. I know Phil probably is too humble to accept that compliment. So, but to help us understand what SEI is thinking during what has been a very active first 5 months of 2025, edge of the seats, lots of opportunities to have those eyes wide open moments as we watch the equity markets do their thing. So Phil, thank you so much for investing your time, sharing your wisdom, your thoughts, and your perspective with our client families today, and really look forward to hearing you bring the presentation that you shared with us to life for those who are enjoying this conversation today.
Yeah. So Kyle, good to see you again, and my pleasure as always, and thanks for having me. So I will say, I kind of sent you a presentation. I want to say it was early April. And given how much activity there has been in both the policy front, the markets front, things have changed a bunch. So I've got a number of different slides that we've updated. But I will say that we can make this conversational, and there are a lot of moving pieces out there, a lot of which we can't update slides fast enough for how quick things are changing out there. So I'll share my screen here, and we can dive into what I've prepared, but then it open to steering the conversation anyway. If people have questions on one topic or another, happy to kind of go off the script and address whatever questions or concerns or thoughts anybody has. So every quarter we kind of put together a investment outlook, and there's always sort of a theme to it. And this presentation was put together really the end of March and presented really early April, so just about a month ago. And really our story was that diversification is working, and I'll get into this throughout the presentation. But if you look back over the last 10 or 15 years, you pretty much diversification has been something that's held you back. If you just bought the S&P 500, you probably would have been better off than if you dealt with, investing with bonds or international stocks. And this is the first time in a while that we're actually seeing a big change in that. So we'll go through that. So I got a couple of slides on just trying to provide some context of what happened over the last 5 months or 5 weeks, really. And really this beyond the peak of uncertainty. So we had this huge, recessionary fears spiked. Markets got extremely volatile. We'll talk about that. And we're obviously past the sort of the worst of it. We'll talk a little bit about diversification. There is this concept of the big cycle, and this will probably be new to some folks, but I think some historical context that'll be important for folks there. I'll try to touch a little bit on the economy, and we'll see how far I get through all of this stuff. And then we just had the House Ways and Means Committee just come up with the latest update on the tax bill that's coming out. That I don't have a slide on it, but I've read through a lot of the material. We could touch on that. And then somewhere in all of this, I'll let you know, hey, what are some of the actions we have taken so far this year? Because we haven't just been sitting on our hands there. We have taken some action in some places. So let me start with the first one. looking through volatility. So this is the fear index, or known as the VIX. And this goes back to 1990. And I provide this just to provide some historical context. So just recently we got above 50 on the VIX, which you can see over here. And I called it the tariff tantrum. I don't know, somebody in the media will give it a better name, after this is all said and done. But every point here that gets above 40, and just for those of you who aren't aware, the VIX, when stocks go down, the VIX tends to go up. And so it's a measure of, that's why they call it the fear index. As the VIX rises, it's usually associated with stocks falling. And so I put every point where the VIX closed above 40, which is obviously a high level. It doesn't get there often. I put I annotated what was happening at that point. So obviously we had COVID, which was a big scare, European debt crisis, 2008 with Lehman going under. And so you'll notice that not many times do we get the VIX above 40. And the reason why that's important, why I picked 40 is really the reasons on the next slide here. So if you were to take, and forgive me, let me explain so you get your orientation right. All of those dots that were on the prior slide, they're plotted on this horizontal axis over here. So the level of the VIX is this way. Here's our 40 number. And on the vertical axis, we have the 1-year forward return for the S&P 500, just broad stock market, okay? Most of the time, the VIX is low. It's somewhere, between 10 and 20. And then the times that it gets above 40, I changed the color to all those, made them all blue, because those are the periods we wanted to kind of isolate. And what you'll notice is, one, it doesn't happen very often. It only happens about 3% of the days is the VIX above 40. But if we look at the average return 1 year later for the S&P 500, it's up about 33% when the VIX spikes like it did last month, versus the sort of, normal return that we would expect, equity markets to be, around 9. So the moral of the story here is, at least, several weeks ago when fear was high, is, look, we've been through times like this before. It passes. And usually if you can hold on, the patient investor is rewarded. And so far, we've already seen from when Trump rolled back the tariffs, I think the stock market as of yesterday was up about 18% since April 8th. So already a huge jump up here, but just provide some historical context to that. The other thing I'll mention is just usually the biggest up days in the market happen in close proximity to the biggest down days. And so this is every day going back to 1985. And so it's a mess of days in here. But what you'll notice is all of the big upward spikes tend to happen right after the big down spikes. And so, if you were worried on Liberation Day, or, whatever it was that, when Trump rolled these out his tariff plan, the market had a negative reaction. And actually, believe it or not, we had the 5th worst 2-day stretch for the S&P 500 since 1950. So it was not a good environment there for a couple of days. But fast forward to April 9th, Trump rolls back his tariffs, and it was the 3rd best 1-day gain at 9.5% all in 1 day on April 9th. And obviously the market has continued to march higher. So the moral of the story here is, even when things get shaky and you look at, CNBC, or you turn on the news and, the news is saying stocks crash. Okay. Yes, but it's usually the big up days are come right on the heels of those. And so you don't want to, get too nervous and take action and get out, because that's usually where you're going to see the biggest days. Last one of sort of this historical, volatility related piece. But this is going back to 1985 again, and this is every year the S&P 500's return for the year in blue up here. So these blue bars, and the red dots down below are the maximum peak to trough decline that we saw for the S&P 500 during that year. So here we are over here. We had a 19% correction. The market has already recovered all of it as of yesterday. So as of yesterday, we were basically flat for the S&P. And so, but the important piece here is this little box down in the bottom left. So even though over these 40 years or so, the market's averaged a 10% return, due to the effects of compounding, it's not up, 400%, it's up 3,400%, right? And that's just the effect of compounding all of these years of positive returns. However, you have to be willing to endure these drawdowns that we saw. And 19% is a little bit bigger than average. On average, we suffer a 14% drawdown. 19 was a little bit bigger, but certainly not as bad as some of these big down periods we've seen. So just to provide some, again, historical context, this is not abnormal. We've seen this, before 2018, we had it, COVID, we had it, 2022. So every couple of years, we go through one of these bigger corrections. And so far, we've already come out of it at lightning speed. So I mentioned diversification is working. So on this slide, and this is a little bit dated, but so forgive me, it's not up to date, but the story is the same. So this was performance as of April 3rd. So it's a little bit over a month old. It was right after Trump announced all of his tariffs. He announced them on April 2nd. Later rolled them back on April 9th. But we're comparing on these three different charts. We're looking at international stocks versus US stocks. So international stocks are the gray up here. US stocks were blue, and they ended up going much lower and then bouncing back. And then we have bonds versus US stocks. So bonds is here in gray, so appreciating over the year. And then we had value stocks versus growth stocks. Again, value stocks outperforming. And really over the last 10 years, really 15 years, it has been all US large cap growth stocks has been what has driven the market higher, whether it's the Mag 7, Microsoft, Apple, all those names. Previously, we called them FANG, 5 or 6 years ago. It's kind of this revolving door of the big growth tech-oriented names. But this year, what has happened is that we've actually seen international stocks outperform. We've seen bonds do better, and we've seen value stocks outperform growth. And really, the pain was really felt in growth stocks. As of this, at this point, they were down 15%. They ended up falling about 20%, and have since recovered some. But the moral of the story is, if you've had a diversified portfolio, it hasn't been that painful on the grand scheme of things. I'd say most of our sort of balanced portfolios from peak to trough, they were maybe down 7% or so. While the headlines out there say US stocks crash, whatever it may be, yes, but if you were diversified, it certainly benefited. It provided a much smoother ride. So that's the gist of what I wanted to point out with this slide. I probably should update it with the latest data, but international stocks are still up 15% year to date, while the U.S. markets have now gotten back to even. And I think the reason why this is happening this way is I think kind of set in market history a little bit. And now this is going to require you to put your maybe a little bit of a thinking hat on. And so let me explain what we're looking at. So first of all, let me start with the thesis here. So every economic cycle, there is one country that stands out above the rest. And for the last 15 years, it's been US stocks. We have outpaced every other country by a country mile. But it's different every cycle. So if you went back to the early 2000s, it was not the US equity market that was the standout outperformer. And so let me explain on this chart what you're looking at. First of all, we have these red vertical lines. These are the first month that the US economy entered a recession. Okay, so US economy goes into a recession. Pretty much the global economy goes into a recession because we're so large. And at each one of these red lines, we track the performance of US stocks in dark blue. This is us here. And then we track international stocks in gray, okay? And then in each one of these cycles, I took what was the kind of the star performer country in or asset class during that cycle. And importantly, I would say I didn't put COVID on here because COVID didn't really count as a recession. We kind of backstopped everything. The Federal Reserve stepped in. It wasn't your normal recession, if you will. So this section here is, the last 15 years is really uninterrupted. But what you'll notice is over the last 15 years, US stocks are up 300%. International stocks, which is this EFA index, they're up only 11% over 15 years. Okay. You go back to the prior cycle, and it was international stocks that were outperforming, really on the back of China, right? China was the big outperformer. And if you go to the prior cycle, it was US stocks again. And that was the 1990s, where we know the NASDAQ up here. And then prior to that, if we test everybody's memory, in the 80s, and really the 70s and 80s, it was Japan was the center of the investing world. And the Nikkei was the star outperformer. And so the moral of the story here is that during every cycle, leadership changes, and it's usually because the policy response to a downturn is different from one country to the next. And it just so happens that over the last 15 years, we have had extraordinary monetary and fiscal policy responses to a downturn. Whether you go back to COVID, whether it was more recent as the Silicon Valley Bank, whether you go all the way back to 2008 with the bailout of all the banks with the TARP program or whatnot. And so the gist here is that the market is aware of this, that US large cap growth stocks have been the star outperformer by a mile. And everything else around the world has been left largely for dead. And so as we start to get fears of a recession, the market starts to price in a change between this relationship. So what you see is growth stocks, US growth stocks start to take it on the chin, start to decline, and everybody starts buying what hasn't gone up, which is international stocks. So again, another kind of a very long-term look at why diversification is working now. It's not just something as simple as people are selling US stocks because they don't like Donald Trump. It's a little bit more seated in market history. And this is going to be something that will probably be the driving force of equity returns. I would say in the next couple of years is this relationship. Do we experience a recession in the near future? And then this big rotation that will be from US stocks, to international. I mentioned, are we going to have a recession? No, we're not going to experience a recession. We don't think that's going to happen. If we were on the cusp of having a recession, what just transpired over the last month probably would have been enough to tip us into one. We don't think that's going to happen. Okay, just to put again another thing for historical perspective. Again, these economic cycles are extremely important. And so this graph, actually, this one goes all the way back to 1900. Okay, and what this is every economic cycle. In every month, we're just counting up how many months is the length of each economic cycle. And again, I exclude COVID because COVID was has an asterisk on it. And so if you look at the latest economic cycle, again, ex-COVID, we're over 15 years old. The longest economic cycle before that was the 1990s, right? And again, another period where US stocks did exceptionally well. And so this is unusual to say the least. But it doesn't, economic cycles don't die of old age. But I think it is worth pointing out just how long this economic cycle has been, and whether you like the Federal Reserve or don't, or you think Trump is right in criticizing Jay Powell, they have done a great job, at least by this measure, of maintaining the economic expansion, managing interest rate policy to balance balance growth and the labor market and keep the economy going. So, big picture, again, a lot of it comes down to the economic cycle. Diversification has certainly been working. And since this latest, over the last 5 weeks or so, we have seen one of the sharpest rallies in the stock market, really on record. And now this chart, I apologize, is a little bit of an eyeful, if you will. But let me explain what we're looking at. So what we did is we went back to 1950 and we said, okay, show me every instance where the stock market dropped 15% from an all-time high, and show me all of those kind of overlaid with each other. We're basically looking at history saying like, okay, like how does this play out? And that's all these lines going across here. Now, importantly, the red lines are periods where we experienced a recession within the next year. And just all of these lines are linked at day zero here, which is the day that the market fell 15%. On the left-hand side is the year leading up to that point, and to the right side of that is the year after we experienced a 15% correction. The red lines are all the periods where we experienced a recession. The blue lines are where we didn't experience a recession and the economy, stayed resilient. Now, the dark red and the dark blue are just the averages of those, which is, hey, if we do experience a recession after a 15% decline, believe it or not, the S&P 500 is basically flat over the next year. Okay. Now, most people anchor back to the last recession that we can really think about, and that was 2008. Now, that's this one way down here, which, if you think back in history, you go, okay, well, that's the most, recent occurrence. That was really an outlier, right? So even with that in the mix, even if we experience a recession, stocks are flat a year later after a 15% correction. If we don't experience a recession, we're on the blue line. We're up about 15% or so. And then here's 2025. And I updated this as of yesterday, just because this run that we've had is pretty extraordinary. So we're up 18% since Trump rolled back his the tariff plan. And we are far in excess of any prior 15% correction. So moral of the story, the economy was in great shape in January, February. We took, obviously this policy action of the tariffs. The market obviously did not like it, and it sounds like pushed Secretary Bessent to urge Trump to back off, and he did on the 9th, which is really when things bottomed, and we've had this great recovery so far. Okay. Kyle, how am I doing? I know you wind me up.
You're doing great. You're doing great. Okay. I didn't want to interrupt your flow. And I think this is a very interesting slide. Some of it's a little hard to see on my end. I don't know if that's my computer graphics or what's going on, but I think here's a key point that I'm taking from this, right? Is that policy and economic strength are two different things, right? And I think we confuse those for a little bit. That in the equity markets, the economy and policy are yet three separate things, right? And so coming into this, but it's funny. I hadn't read I don't know if I saw the tariff tantrum too as well. That must have been something I read because I'd forgotten you wrote that. I love it. I've got a 3-year-old right now, and they throw tantrums, right? And you sit back and you go, and I think the wisest thing, I think it's a great descriptor, because with my 3-year-old, when he throws a tantrum, I've got 4 kids. They've all done the same thing. You sit back. Here's your responses. Often as a parent, the wisest thing to do is sit back and wait. Let the child navigate that tantrum, right? They have to learn how to self-soothe a little. And I think that same thing can be said about our investments, is that when the market throws a tantrum, the best thing to do is sit back, let the thing self-soothe a little bit, let it calm itself down. You don't run up with a lollipop or you'll teach the thing to tantrum all again, right? And so I think that's an excellent point. And I think the thing that a lot of us misunderstood is stocks are a reflection of the economy. And that's not always the case. These things, sometimes there's a divergence between economic strength and equity market strength. And we saw that. And I think the markets were very much predicting that none of the trade agreements were going to happen that are beginning to unfold, and baked in a kind of a worst case scenario. Would you agree with that, Phil, a little bit?
100%. And yeah, a lot of market prices, and I don't have a slide on it, but it is a lot of it in the short term, inside of, let's say, 2 months, is mostly emotion. It's not driven by fundamentals. It's a lot more of it is just, hey, how optimistic were people in January and February. And if you look back at it, people were probably a little too optimistic. And then all of a sudden the policy shift happens and everybody gets really dire. And that swing in emotions drives prices just as much as the actual underlying economy. And actually, that's actually a good segue if I jump forward here. So one of the things, since we're talking about the economy for a second, there's not sure if anybody noticed, but in the midst of all of this, we actually had a negative quarter of GDP growth in the first quarter. So the graph on the left-hand side here is GDP growth going back over the last 10 years. And it's how GDP is calculated. They do how much did the economy grow this last quarter, and then we annualize it. And if you do that math, real GDP growth, which is after inflation, was minus 0.3%. So a tiny little contraction. And everybody thinks if you get 2 quarters of negative GDP, that's a recession. That's not the actual definition of it, but that's the shorthand math for it. The true definition is a much more subjective point. But what I want to point out here is that oftentimes the piece of data that you get delivered to you on a alert on your phone, or that's the headline of the Wall Street Journal, doesn't always tell the whole story. And I'm going to try and make this make sense without going too far down the economist sort of path here. But inside of GDP, there are really 4 big components of it. And I list them over here on the left. So 2 of them are just consumer spending. So what do we spend on goods? What do we spend on services? That makes up about 70% of the economy. Consumption on services alone is half the economy. And then there's private investment. How much do we are people putting into building new homes or building a new factory, whatever it is? That's all private investment. And then there's government spending. So those are the 4 big buckets. The one that's not included here is imports. Okay, and so what happened really in the first quarter is that we saw a massive increase in imports of people front-running tariffs. Hey, I know Trump's talking about tariffs. I'm going to go order everything I need for the next 6 months to make my widgets or whatever it is. And that is a negative impact on GDP, at least on the way that the Bureau of Economic Analysis computes GDP. I would argue, though, that's not really a reflection of how the economy is going. So instead, on the right-hand side, I provide an alternate look at this. And what if we just took these big 4 components, forget about imports, exports. We just took these 4 components and we said, how much did those 4 components grow versus the fourth quarter? And we annualize it the same way we do GDP. And the economy actually grew at an 8% annual clip. If you exclude imports and exports and you exclude inflation. Okay, so this nominal GDP, which is they recorded at 3.5%, it actually grew at 8 by the measure that we actually care about. The difference is all imports that came in because everybody was front-running tariffs. The reason why this number matters more is because that's a better reflection of what corporate revenues are going to be. Okay, so we care about, hey, how many Caterpillar tractors did Caterpillar sell, or how many Tesla cars did they sell? That's all captured in these 4 buckets, and that's shown over here. So the moral of the story is the economy before our little tariff tantrum, the economy was just fine. The economy was in really good footing, and if anything, it was accelerating and put us in a position where we could tolerate maybe a policy misstep and come through the other side. Okay.
I'm gonna feather in a question here. In case those who are participating on this live, questions are open. You're welcome to ask them. I'll feather them in. So we've got a 90-day pause on tariffs, right? As China works toward, and the United States works towards what we hope is a much more long-term comprehensive trade agreement, right? What do you see is that if that doesn't come to any sort of positive resolution, do you think the market's priced in positive, negative? Is it somewhat hard to tell? And anything that you think people should be doing to guarding against the potential, negative or that some trade agreement not coming to a resolution over the next night?
So, okay, so good question, and let me just skip forward because I've got okay, so if we so okay, if we had the tantrum on the way down a month ago, we're probably now getting a sugar high on the way up. So markets are now discounting any economic slowdown that's going to come from the tariffs. Just as a point of just to orient ourselves, on the left-hand side here, this is the tariff rate for the US going all the way back to the 1700s, long time. And the tariffs that Trump proposed were basically a 22% tariff, tariff across the board. If you account for how much we import from every country and do the math on it. With what was just rolled back 2 days ago, we're down to a 15% tariff across the board. The market is discounting the impact of that tariff today because the market went from, hey, the sky is falling to, hey, they're going to make a deal, and now the market is starting to recover. So there is going to be a negative impact on GDP, certainly over the back half of this year. Once they actually figure out what the tariff rates are going to be, the tariff rate isn't going to be zero. It's going to be higher. We don't know what it's going to be. The market has already probably jumped the gun a little bit on how optimistic it has been, and so it would not surprise me if we give back a little bit of the rally that we've seen. But I think tariffs being the key risk going forward, I think that ship has sailed. Right? It's not going to become a as big of a problem as what we saw. Mainly because, Kyle, the thing that you mentioned, hey, when a child's throwing a tantrum, just let it marinate for a minute. The market is very good at digesting information quickly. And so once everybody understands, okay, tariffs are a deal, there are money managers out there that they know the breakdown of, hey, if this number goes to 12, what the impact is. The market's already kind of digested all of that. The risk going forward would be something that challenges the labor market. If the labor market, we start to see job losses, that's when things start to get serious. So you were going to see a decline in top line GDP growth. Those numbers that I shared earlier, that's certainly going to slow down. But for our purposes as investors, we care slowing down is fine. We just can't have it stall. And at the moment, I would say there's no indication that the economy is stalling. There is going to be some back and forth. We've got now multiple 90-day pauses. There are a lot of trade deals that need to get done. There are going to be some bumps along the way. But I think the most important thing and the thing that the market is really keying off of is, this is Trump, I think, really took the playbook right out of his book, probably The Art of the Deal. You come out guns blazing in a negotiation. I'm going to demand everything. He put all these tariffs on, and our financial markets called his bluff, and our market started to wiggle. And he said, you know what? And really, Scott Besson is the one who said, hey, Trump, you can't do this. You're going to cause a real problem. And Trump backed off. And unfortunately, I think it probably weakens Trump's hand at the negotiating table over this 90-day pause, because the foreign countries don't have an incentive to rush to the table. He's already walked back the tariff rates. He walked back tariffs on smartphones and laptops. So he's giving concessions already, which tells us that this rate is going to be lower likely than it is today, which is what the market is responding to. But there will be some negative consequences to it. Companies that are importing goods from China, their prices are still going up. It's just not as bad as what we thought. And for financial markets, the direction of travel is more important than the level. So this level at 22% tariffs is, was the highest in over 100 years. This level now on May 15th is still the highest in 75 years, but the market cares about the direction that it's going more than the absolute level because things are improving. So I don't know, Cal, does that answer your question? I went on kind of a tangent there.
Absolutely. Absolutely.
Okay, let's see. What other what other pieces do we have? Well, let me jump to kind of the framework that we have been kind of working off of. And look, the world is a complicated place, and sometimes it's easier just to draw on a slide to kind of frame what you're thinking. And this has been our our sort of view of things really for the last probably 18 months or so. I mean, so think of this as time going across here. So as we're this blue dot here, and over time, this is further out in the future. This is where we've been. We've been in this period where the Federal Reserve has raised interest rates. I skipped the Federal Reserve one, but Federal Reserve has raised interest rates. They've cut them a little bit here, but interest rates are still high. If anybody's looking to buy a piece of property and you look at what the mortgage is at rates at this level, it's sticker shock. So economic growth, which is kind of what this blue line is supposed to represent. It could be economic growth, it could be the market, just the overall sense of things. We're this blue dot, and the economy is slowing down mainly due to previously due to the Federal Reserve having interest rates as high as they have. Obviously, tariffs are going to slow things down a little bit more. But the two big signposts that we look for the economic cycle peaking are usually you got to have the labor market show weakness, so unemployment rate going up, large scale layoffs out there, and it comes in conjunction with weakness in the credit market. And when I say credit market, we're talking about companies being able to issue debt to finance their operations. So can Ford issue bonds to build a new factory? When they can't do that, that's credit markets weakening, and that usually is a precursor to labor markets weakening. And when those two happen together is where we get the peak in the economy rolls over, and at which point you see consumer staples and defensive type equity names really outperform. And eventually we come out the other side, and then we get, as I mentioned, every cycle has different leadership. This last 15 years, it's been all technology, communication services. Nowadays, it's anything related to AI. In the future, it's going to be something totally different. And you just want to not be totally anchored into what's worked for the last 15 years. Recognize that in the future, the leadership's going to shift to something else. But it's usually somewhere where labor and credit markets deteriorate together is where things tend to peak and things start to get to be a problem. Outside of these two things happening, we kind of consider these things, these tantrums, like we got more of a buying opportunity than not. And so just to speak to kind of what we have done this year, it was April 21st, we did rebalance portfolios. And so if you had a balanced portfolio, we took 3 to 5% of what you had in fixed income or international stocks and bought US stocks on April 21st. So that was, 12% ago or so. These periods where we get the market kind of disconnects from reality, and it always is scary at the time, we'd see those as opportunities. However, if we get to a period where either labor and credit are being challenged, you'd likely see us make some more structural changes in portfolios to get more defensive in preparation for new cycle leadership that would start, on the tail end of that.
So let's talk about a little bit about tax, right? So we've got the sunsetting of Trump's original tax bill at the end of this year. You've got a draft, if you will, of, I'm not get political here, right? Whether I like Trump or don't like Trump's irrelevant. Very peculiar name, the big beautiful bill, but there you are. We've called things, it's Congress is notorious in naming things uniquely, right? So lots of different provisions in there. An increase in I've seen some increase in SALT from 10,000 to 30,000 which will affect you guys in California probably more than us folks Indiana, we get clients in 17 states, so each person's impacted by that. But a big question I have in this is, what are you seeing in the bill? I know his cuts the first time, a lot of that was on the corporate side, which boosted, retained earnings for corporations. We saw some tick up in equity markets due to that. What are you seeing in the bill overall? Any opportunities you see in that if it gets passed to be positive, either for disposable income for Americans or, corporate earnings, anything that you see that could be, positively a boost for the economy overall?
So, so I have the House Ways and Means report open on my other monitor over here because we're still parsing through it, and there's a lot to go through. I will say I don't have any I don't have anything right now that's oh, hey, this is going to benefit or that's going to benefit. First of all, let me emphasize, this thing is not done. This is just a draft of it so far. I would say my biggest takeaway so far, and Kyle, I don't have a, hey, this group's going to benefit more than another. Although the thing that I would say is concerning is probably the amount of cuts, the amount of tax cuts that are in there. And keep in mind, behind the scenes in all this, there was this sort of understanding that we were going to cut government spending, whether it was DOGE, the updated budget for 2025, which never got passed. There is an expectation that's been set that we are going to get our fiscal house in order.
Yeah.
And it doesn't look like there's much in here that's going to increase taxes at all. I mean, it's certainly going to be a big tax cut. And I think the thing that I would say gives me a little bit of pause and concern is if we put the spotlight on the deficit over the last 2 to 3 months with Elon Musk with a chainsaw on stage saying, hey, we're going to cut the deficit and everything, and we don't do it, I fear that the market may push back on all of this. And so you may see higher long-term interest rates, which would be a challenge. And it wouldn't be the first time in recent past that we've seen this. I don't know if anybody remembers the shortest sitting prime minister in the UK.
Yes.
Got elected on a pro-growth agenda. Hey, we're going to spend a bunch of money. We're going to do a bunch of these things. And the bond market had a panic, and their interest rates spiked, and the Bank of England had to step in and backstop their bond market. I worry that while Trump ran on this idea of, hey, we're going to balance the budget, but we're also going to cut taxes, and there's no tax on tips, and I see there's no tax on Social Security if you make less than a certain amount, and no tax on overtime. There's a lot of no tax stuff, and if we don't have a commensurate decline in government spending, we're gonna have I think a little bit of a challenge. So to your point, Kyle, I'm like, who's going to benefit, who's not? I don't have a full breakdown of it because it just came out a day ago. But
it's green. It's green for certain.
Yeah. So but I think that highlights the challenge. I think if there is something that's going to be a little bit of a headwind to us in the next, call it 3 to 6 months, it wouldn't surprise me if it's something with this combination of, hey, we're trying to bring down the deficit, we're trying to do it with tariffs, which we're cutting our tariff rate, to make these deals. We're trying to do it with, DOGE cutting spending, but that is, I think, proven to be underwhelming so far. But at the same time, we're lowering taxes. Like, those don't all balance out to balance the budget in any way. And we've set an expectation for the market that we are going to get our fiscal house in order. And if we don't do it, that may result in higher long-term interest rates, which probably puts housing further out of reach for more folks. And creates a different set of challenges. So, but it's going to evolve probably 42 times between now and when it actually gets passed. So we'll have to just continue to sit on the edge of our seat and see how it pans out.
I'm glad I'm not our accounting friends having to figure out how to navigate, wise tax planning in 2025 with so much uncertainty in that space.
Yeah.
That's certainly the case. So, Phil, anything I know we cut out sections, you added things, anything that you feel that we didn't cover during this? Any final questions from anybody attending? Anything that you feel, Phil, for you or anyone else attending that we should cover in our time here together this afternoon?
Yeah, I mean, if you wind me up, I could keep going for way too long. So I would say open for any questions, just an open invitation. Somebody's got something that comes to mind, by all means.
Well, so I could do this all day long with you, and you and I have had some longer calls, since your time in joining SCI, which I always love it. So I think one of the questions I have, right, and I've seen some elements out there on this, some articles, is how much U.S. debt is going to have to be, it matures, they got to reissue it. That new debt under current rates is clearly going to be higher. I've seen some tranches that appear to be maturing, I think this summer, if I'm reading the information I've read correctly. And consequently, we're already seeing a pretty substantial interest carry for our government in terms of how much of our overall tax revenues are used just to cover interest rates. And that with higher rates, that's not getting better, right? That picture looks a little bit gloomier, if you will. How does that affect, long-term growth, where tax rates should be, and implications on U.S. growth overall due to that debt burden?
Okay, so all very good points. Yeah, great question. So here's and yes, I think you don't have to look far. You'll see a hockey stick chart of government debt or government interest payments. We're now spending more on interest than we do on defense, and it's just going up. I think we're running at $1.2 trillion per year is the run rate on interest expense for the government. Now there's kind of what I mentioned earlier. The devil's in the details with this, and it's not as bad as it looks. Partially because if we went back to last year, Janet Yellen was running the Treasury Department. And one of the things that the Treasury Secretary gets to decide is, hey, we've got to issue a whole bunch of debt every year. They get to decide how much of it is issued in 1-year Treasury bills, how much of it is issued in 30-year bonds. And last year, Janet Yellen issued an awful lot of Treasury bills, okay? And I don't have the exact number on it, but there is something like $7 trillion of government debt that's rolling over this year. Now, the important thing with that is short-term interest rates aren't any higher than they were last year, right? The Federal Reserve's actually lowered interest rates by 100 basis points, 1%, since last year. And a huge chunk of that debt that's maturing was just 1-year Treasury bills that were issued last year. And so we are already paying that elevated rate on T-bills. Now, when a 10-year bond matures that was issued back in 2015, that's going to go up because the 2015 interest rates were 1.5%. But the vast majority of the debt that's maturing is just T-bills rolling over. And what Scott Bessent really wants to do, and why he has been adamant about trying to get interest rates lower, he would like to stop issuing so many T-bills and issue longer dated bonds to kind of balance out the maturity schedule of our liabilities. But he needs interest rates to be lower in order to do that. So if I put that all on a bow, that big hockey stick of interest expense that the government is paying, it's going to start to level off because interest rates already went way up. Most of it, the debt that is rolling over is already tied to short-term interest rates that already saw the big rise in interest rates. And so I think it's going to start to level off. Not that the situation is contained. We still need to get our fiscal house in order. We're still running a 7% deficit, which is unprecedented outside of a war or a recession. But there's a real question about whether or not, the Republicans can muster the intestinal fortitude to actually do it. and it's yet to be seen.
Yeah, and so many challenges there, right? In terms of what's actually driving the debt, right? And driving that deficit. They're cuts to the things that are very close to people's hearts, understandably, right? That so much of our budget is defense, and people have strong opinions on that. And then Medicare and Medicaid make up a huge remaining portion of that, the perception that it's, pick the project you don't support, right? That's making a large portion of the debt. Like, public television and PBS are not driving huge portions of our is a arbitrary example, right? That's not moving the needle on the debt. And so we got some tough decisions on both sides of the aisle. Going to take a unified approach. I think that's the hardest thing these days is having the ability to work with somebody who you don't necessarily agree with that much.
And let's face it, politicians these days, they don't collaborate on much at all. And it's been that way for 20 years, and that's why we're kind of in that mess. But I would say the only thing you could probably count on is that there's probably, Trump is a bit of a divisive force. There's probably not going to be much, collaboration on some of these things. So those big things that are holding back our, us balancing the budget. You mentioned Medicare, Medicaid, Social Security. Those are third rail topics for politicians, and they're not going to take action on them until the market forces them to. So at the moment, they could kick the can down the road.
Yeah, 100%. Well, Phil, thank you so much as always for your time. We appreciate the partnership that we have with your organization, the wise choices you're making, always making yourself available to myself via email and phone call, when markets get topsy-turvy, and then setting time aside here to talk to our clients. To everyone watching this live, to those who watch this later, we appreciate your trust. It's in years like this and times like this that it's even more humble to sit, alongside you and walk alongside you during uncertain times and collectively make wise decisions and hopefully make an impact on you, your family, and the people you love. So we thank you for that trust. And as always, if you have any questions after this presentation or when you watch it later, please certainly feel comfortable reaching out. Phil, again, thank you so much. Troy, thank you to you and your team, and we hope to see all of you soon.